Let's talk real estate, though, with an international focus. That's our theme for Hot Picks today. Our guest says even though the overall consumer in many cases is struggling, demographics are still a positive factor. We're joined by Zhang, portfolio manager in global real estate at Cohen Steers. Thanks very much indeed for joining us. Start off with your first idea, if you would. Acadia Realty trades in New York, AKR being the symbol. What are they all about, please?
First of all, Andy, thanks for having me. Acadia Real Estate is a retail company, and over the past decade, brick and mortar retail has gone through a massive disruption. People thought they weren't going to stores anymore. They were going to do everything online. And the reality is people still like going to stores for the right experience. Now, Cohen Steers is a top shareholder of Acadia. We have known this management team for well over a decade, and we have walked every single asset in the portfolio. Acadia owns high-quality stores that are well located with relevant brand that people enjoy visiting. These are stores in Soho, in Melrose Place, in Georgetown. Yet you have the stock chart here. The stock is down over 15% year to date. Why? Because of what you said, Andy, broader concerns about the consumer. But the reality is Acadia's portfolio, the demographics are the affluent that are still doing well. They're still spending. So fundamentals for Acadia and its tenants are still strong. And that is the mispricing we see today.
So I think you said they're in Georgetown, a pretty prosperous part of Washington, and Melrose Avenue in LA?
That's right. So those are markets broadly that are struggling, of course, because of what's going on in Washington and the shutdown there. And LA as a market has been tough. But these are such select blocks that are well curated, that has a bigger draw for the affluent, that are less impacted by, unfortunately, what's happening in the broader market right now.
Another name you have, and it's an AI play indirectly anyway, Crown Castle. And it's a tower company that provides or a venue for network equipment for the telecom carriers.
That's right. And what's different about Crown Castle is it hasn't seen the lofty valuations that we have seen for the rest of the AI market. This is actually a stock that is still trading at well below pre-pandemic levels. So we would say the upside is not priced in here. So Crown Castle, the thesis here is that ultimately, when we all do more with AI and more of those applications move to our phones, that is going to generate a greater need for network equipment. Now, Crown Castle is the tower company that holds the telecom network equipment for the wireless carriers. So as more applications move to mobile devices that will strain the mobile networks, carriers will need to add more equipment, create more capacity, and that means higher rent for Crown Castle. And again, something that we don't think is priced in today.
And finally, you have a Canadian idea for us, Dream Industrial REIT. They're a warehouse company.
That's right. So before I go into specifics about this company, let me make one point clear, though, which is when we look at real estate, it's generally insulated from tariffs. And how can that be? It's because REITs are typically landlords that collect rent on existing properties and not merchant developers that are more vulnerable to fluctuations in construction costs. But with that said, Dream Industrial and industrial real estate in general has been more impacted by the demand that has been dampened by tariff-related uncertainty. As you can imagine, Andy, in this environment, it's very difficult for retailers to make long-term supply chain decisions. And therefore, we do think that there is pent-up demand that will come back once economic and tariff uncertainty subside. And over the long term, we like the supply and demand dynamics for Canadian industrial properties because, as you know, it is harder and it takes longer to build new product in Canada. So there's an inherent higher barrier to entry.
That's interesting. And so dir.un is the symbol in Toronto. Not sure if we have that chart. I think we just looked at the over-the-counter in the United States. And not a bad yield, 5.6% on Dream Industrial.
That's right. And it's priced at very attractive values because of the overhang from tariffs. But we do think that the long-term fundamentals are very good. And it has a portfolio that is Canadian and European. And in Canada, the properties are in Montreal, Western Canada, and of course, the GTA.
Just while we have you, and it's kind of a little off topic, but when you were talking about retail, we know that there's been this problem with organized shoplifting in both the US and in Canada, unfortunately. Has that changed the retail business very much? I mean, obviously, it's costly for store operators.
It's been a challenge, and I would say some of the urban locations is where you see more impact from what's going on with the shoplifting, and that's coming back, right? San Francisco is probably one of those markets where we have seen a lot of retailers exit that market since the pandemic, and that has brought more attention for the governments to address the safety and shoplifting concerns. So I think it needs to be a partnership between the public and the private to address that issue and to make the environment a more lively environment for not only shoppers to thrive, but where retailers can continue to do well.
Zhi, thank you very much. Zhang joining us there, portfolio manager in global real estate at Cohen Steers.